There are lots of options trading strategies out there, all with different risks, potential returns, and complexities. However, there is one in particular that is simple to use, has a high probability of success at low risk, and can earn you good profits: the options wheel strategy. In this video, I'll give a simple beginner's overview of the wheel strategy and explain what it involves, so by the end you'll have a good grasp of the fundamentals for which to apply to your trading. Before going forward, please understand that this video is made for entertainment purposes only, and none of what I'm about to say in this video constitutes any financial advice. This is my own opinion about a commonly used trading strategy, and I urge you to research it yourself before you use it for any of your financial decisions. Okay, so here you can see a diagram of the wheel strategy, and as the name implies, slap bang in the middle is a wheel. Now, right off the bat, you can see the words put and call. Now, if you have no idea what put and call options are, this video is not for you yet. I will give a quick reminder of what they are in a minute. However, if you have never heard of them or have no understanding of how options work, then I strongly suggest that you go and watch some videos on the basics of options and then come back to this video. Okay, so back to the wheel, and this represents a strategy that you can use on your options trades. Wheels go round and round, and so can your option trades. You can start the trade by selling a put option on an underlying stock, then sell a call option on that assigned stock, and then sell a put again on the exercised stock, and continue again and again selling put and call options on the underlying stock, going round and round using the wheel strategy. All the time you'll be collecting option premium and managing your risk. Theoretically, it could go on indefinitely, just trading the wheel strategy on one stock over and over again forever and ever. That's rarely the case though, and at some point there'll come a time when you'll need to exit the strategy, and then you can start the wheel again on a new underlying stock. Okay, so let's see how it actually works. So I mentioned put and call contracts, so let's take a quick look at what they are before going on to explaining how the wheel strategy works. So there are two types of option contract: puts and calls. And a put option is a contract giving the buyer the right, but not the obligation, to sell a stock at a predetermined price within a specified time frame. Now, that's from the buyer's side. However, with the wheel strategy, we are option sellers, not buyers. Therefore, for our purposes, we can sell a put contract to a buyer stating that we would buy their stock at a price we both agree on, called the strike price, within an agreed time frame. And if that stock's price reaches our agreed strike price, we have to buy the stock from the buyer. The number of shares you would buy is always 100 per option we sell. So if you sell 3 put option contracts to an options buyer, that would mean you would need to buy 300 shares if you get assigned. Okay, now as sellers, we want a good deal. Basically, by selling a put option, we'll be selling it on a stock that we are interested in buying, but at a discounted price. Now yes, that sounds too good to be true, right? How can we buy a stock that is openly trading on the stock market at a price lower than it is currently being traded for? Well, we can do that by selling a put contract on the underlying stock at a strike price lower than its current price. If the underlying stock price falls below our strike price, we must buy 100 shares of that stock, which we buy at the strike price we set when we sold the put option contract. Therefore, we are buying the stock for a price lower than it was at the time of our trade, hence the discounted price. Hopefully this all makes some sort of sense, but don't worry if you're getting a bit confused. I'll go through an example in just a moment. There's just one more important thing to point out, and that is you shouldn't select any old stock to sell a put option on. You want to select the stock that you would really like to own. Perhaps you'd be happy right now to buy it at its current stock price, but wouldn't it be even better if you can get it at a discounted price? That's why we sell put options. Okay, so let's look at an example. Imagine the stock you'd really like to buy is in a company called Rubber Duck Company Inc. and you'd like to buy 100 shares of this company because you believe it will grow and prosper and that its stock price will rise over time. It's a sure bet. So at the moment, its stock price is $110 per share. which is not a bad price. But you'd be even happier buying it at $90 per share. What a good discount that would be. So you'd start off by logging into your broker account's trading console, and then you'll set up the trade. You'd sell one put option contract at a strike price of 90. By strike price, it means that is the price at which you would like to buy the underlying stock if it happens to fall to that level. All option contracts have an expiration date, which you, as the option seller, can choose. So in this case, you choose an expiration date of 3 months from today. So that gets computed by your trading console, and it spits out your potential premium for the trade, $115. Right, that's great. Just by opening this trade, you can get paid $115. Therefore, if someone decides to buy your options contract, they will pay you $115 of premium, which you will keep, regardless of the final outcome of the trade. If the price falls below the strike of $90 3 months from now, you'll have to buy their 100 shares of Rubber Duck Company with the cost to you of $90 per share. So you'll end up buying 100 shares and you'll multiply that by your strike price of 90. So your total cost would be $9,000. That's if it actually ends up falling below the strike price. However, on the other hand, if the stock price of Rubber Duck Company remains above the $90 strike, then you don't buy any shares at all, but you will still keep the $115 premium, so you win again. Okay, so you enter the following trade into the broker's console. It's the Rubber Duck Company Inc. with 3 months expiry, $90 strike price. The type of option is a put option, and you will sell to open, which means you will sell the put to open the trade. And for this particular option trade, at that strike price, at that expiry date, you will receive a premium of $115. Okay, so then you click the sell button and bang! Almost instantly, somebody comes along and sees your contract and buys it. And you look at your account balance and great, you see $115 premium is sitting there. So you've just made money. So now you sit on your hands and wait for 3 months. Okay, so once the 3 months are up, there are 2 possible outcomes. The first outcome is that the stock price closes above your strike price of $90. So for example, on the final day of trading, the underlying stock closed at a price of $98. During the 3 months of your options contract, the price moved around and it fell a bit from 100, but it's still above your $90 strike price. So in this case, the buyer will keep hold of their shares of Rubber Duck Company and you'll walk away with $115 in your broker's account. The trade is over. Now you can go and sell another put option on Rubber Duck Company Inc. and make more premium. So in this case, you're going back to step 1 of the wheel strategy. And you can keep doing this each time you don't get assigned the shares. You sell a put, collect the premium, the price of the stock finishes above your strike price, the trade ends, and you go and sell another put on the stock. Right, outcome 2 is where the wheel starts to turn around. And this is where the stock price closes below your strike price of $90. For example, on the final day of trading, it closes at $87. So in this case, we move on to stage 2 of the wheel strategy. And stage 2 is quite simple. You buy the stock. You buy the shares of the underlying stock from the option buyer because you get assigned their stock. Now, this sounds really bad, right? You have to buy 100 shares at this terrible price of $90 when the current stock price is $87. So you'll be paying $3 per share more than being offered on the open market. But that's not exactly the case. If you think back, this was the stock you wanted to buy 3 months ago, and then it was at $110. So now you've bought it at a really good discount, a $20 per share discount. And you're also keeping the premium of $115, not to forget. So you'll have some great stock that you're happy to own, plus you've made some premium on the side. What happens now? Well, over the weekend, your broker arranges the purchase of the 100 shares, and on Monday morning, you check your broker's account and you see that you are now the proud owner of 100 shares of Rubber Duck Company Inc. So that's fantastic. Not only do you own part of a company you strongly believe in, but you also receive all the benefits that shareholders enjoy. So that'll be you can collect dividends, so there's another opportunity to collect money, and you'll also get voting rights at the annual shareholders meeting. Whether you want to do so or not, that's up to you. Okay, so things are looking pretty good, but we have not finished with the will strategy yet. It's now time to move on to step 3, where things get even better. And step 3 is where you sell a call option contract. And this is selling a call option on the stock that you now own. And as before, you'll be selling that contract to an options buyer. So let's go through that stage. Right, so back at our options page, and this time the call option contract. A call option is a contract giving the buyer the right, but not the obligation, to buy a stock at a predetermined price within a specified time frame. Okay, so once again, we are the sellers of this contract. We never buy options with the will strategy. So in this case, as sellers, we can sell a call option to a buyer stating that we would sell our stock, in our case 100 shares of Rubber Duck Company, at a price we both agree on, the strike price, within an agreed time frame. And if that stock price reaches our agreed price by the expiry date, we'll have to sell our stock to the buyer. So this basically means that you are going to sell a call option and set the strike price for either the same price you bought the stock for or a higher price. So if you set the strike price at the same price you bought the underlying stock for and the price reaches that strike, then you'll sell the underlying shares to the buyer at that price and you will break even. If you set the strike higher than the strike price that you bought the underlying stock for, and if the price reaches that level, you'll sell your stock to the buyer for a profit. Okay, again, I'll go through all of this with an example and more details, so hold on. But first, let's consider one key point of the will strategy. As options sellers, we are interested primarily in making money from premium when selling option contracts. We did this in step 1 by selling a put, and now we're going to do it again by selling a call, so we can make more money again from premiums. Now, you might be surprised to know that there are plenty of people out there who want to buy your Rubber Duck Company shares, and they don't even want to buy them from you at the current stock price. They want to buy them at a higher price at some point in the future. Now, this sounds a bit crazy, doesn't it? Why would they want to buy something in the future at a higher price when they can buy it now at a lower price? And they'll even pay you premium to be able to do that. So why would they do such a thing? Without getting too bogged down by complexities, let's simply say that they are hedging their bets. They don't want to buy shares in a company and then the share price drops and loses its value. So they want some kind of guarantee that the stock price is on its way up and gaining momentum. Okay, so they will wait to buy the stock when it's on its way up. So in effect, that is what's happening when they buy our call contract at a higher price than the stock is at now. If the stock price falls or doesn't reach our strike price, then they wouldn't buy our stock. And this is fine for us. We want to earn money from premium. So even if we have to sell off our stocks at break even, we're still happy. We make a profit from our premium, and then there's the possibility of making more profit on the sale of the underlying stock if we sell it at a higher price than we paid for it. Okay, so on to the promised example. Once again, you turn on your computer and open your broker's trading console, and you select the strike price and expiry date for your call option. So this is what you decide on. You have the Rubber Duck Company with a 3-month expiry date and at $95 strike. This is a call option contract, and you're going to again sell to open. So you're going to sell a call to open the trade. And with all these variables, you will receive $126 premium. And we're obviously feeling optimistic about the underlying stock's price performance because we've selected a strike price of $5 higher than what we bought the stock for. If you remember, we were assigned the stock at $90. So with this new strike of $95, If the price rises above it by expiration, we can make an extra $5 profit per share on the sale of our 100 shares, a total of $500 profit. Okay, so you click the sell button and within a few seconds, bang, you've sold the option. Your account has been credited with $126 and you still own the stock. So again, it's time to wait it out. And 3 months later, there's one of two outcomes which are possible. Outcome number one, the stock price closes below your strike price of 95. So, for example, the stock on the final day of trading closed at $92. Over the 3 months, the stock price has moved around. It's gone up a bit, down a bit, but overall it's increased a bit from $87 to $92. So it is already in the profitable area for you, but it's still below the $95 strike price. So therefore, you will have to keep the shares of Rubber Duck Company and you'll walk away with $126 premium. You always keep the premium, whatever happens. So now, what do we do? We've still got the stock, so let's sell another call. You can go and sell another call on the Rubber Duck Company and make more premium. So this takes you back to the beginning of stage 3 of the wheel strategy. You'll be selling call options on the underlying stock and you'll make premium each time you do that until the stock's price finally closes above your strike price. At that point, your shares in Rubber Duck Company are exercised away from you as the buyer of your option contract will buy those shares at the price of the call option strike price. So in the example's case, you would sell your 100 shares to the option buyer for $95 times 100 shares equals $9,500. And this is what happens in the second outcome. So outcome number 2 is exactly that. The underlying stock's price closes above the strike of $95 by expiration. So for example, the stock price at close of trading on the final day is $98. And this would move you onto stage 4. And stage 4 is to sell the stock. You sell the shares of the underlying stock to the options buyer. So you've reached the final stage of the wheel strategy. Well, perhaps not quite. We'll talk about that in a moment. But as the rules of the option contract state, you have to sell your shares to the options buyer if the underlying stock price, by expiration, finishes above the strike price. And you've made some really good profits. Just to note, you're not actually going to have to go in and sell your shares. Your broker automatically does that for you. So with all this in hand, after going around the wheel one time, look at your profits from the complete wheel trades. In stage 1, you sold one put option and received $115 premium. Then add to that in stage 3, after you assigned the stock, you sold one call option and you received $126 premium for that. Then in stage 4, you sold your 100 shares. The underlying stock price finished above your strike price, so you sold them at a $5 profit per share, and that's for 100 shares, so you received a profit on sale of stock of $500. So this gives you a total profit of $741. Not bad at all. But maybe you're a little bit disappointed. You really enjoyed being a shareholder of Rubber Duck Company, and now you've lost all your shares. But that's no problem at all, as you can always get them back. And as we did at the beginning in step 1, you can sell puts again. We're right back at the beginning of the wheel strategy. This is where the wheel can go round and round indefinitely. You can sell some more puts at a strike price lower than the underlying stock price, and then if the underlying price does fall below your strike by expiration, then you'll be assigned the shares again. Then you can sell calls until the shares are sold away from you, and then you can start all over again, going around and around the wheel, making money all the time from premium. And that's about it. It looks very simple, doesn't it? And it is a very simple strategy. It's simple to understand, simple to implement, and effective to use. There are, of course, more complexities that I haven't covered in this basics video, such as how to select stock to trade with the wheel strategy and how to select the optimal strike price, and also when to enter and exit trades and so on. and I take a deep dive into those important areas in our video training course on our website. So please see the link below in the description if you're interested in that course. Okay, so I hope that was helpful. If you have any questions or if anything doesn't make sense, please let me know in the comments below and I'll be happy to answer them. Also, please like and subscribe to receive notifications when I add more options and wheel strategy videos. If you enjoyed this video and want to see more option trading videos, head on over to our website at wheeloptiontraders.com. Here you'll find our Options Wheel Strategy Trading video course. We have over 50 videos and counting, from the basics of understanding and trading options through to using the wheel strategy to get the most out of your options trading. We also have an amazing options wheel strategy tool that you can download. It tracks all your trades in real time and provides key insights to help you with your options trading decisions.